Hello guys, and glad to have you on board again today. Just a quick update. Remember that first of all, each and every week you've got an update, but on TradingView's platform. Those daily updates we make then into the YouTube channel are when required updates are to be done, and pretty much whether we're reaching out a speculative area we've talked about in the weekly updates, or we're getting new signals, or we're just getting totally invalidated at some point. So this is not what we're going to talk about, because into the weekly update this weekend I talked about my pretty much uncomfortable situation with the indices and the fact that I just took an invalidation on a cover intermediate range portfolio strategy. But the fact that I think we're nearing the beginning of another, this one, that just got invalidated in 2 times, the first one in there, the second one in there, or pretty much in here and in here. I think my mirror is right. So invalidation means I generally don't get back into trading right after an invalidation, but I'm also very much uncomfortable within the fact that this wave could still be reaching its end. Though that would be just triggering an invalidation right before getting right back in for another scenario. Of course, that must not be the same scenario, so that's not the same context. This cover trade was to target a 10 to 12% drawdown in prices, no more than that. This one is a slightly different option, is a radically different option though, because this one isn't nearly going back to some support. It's breaking one and retracing eventually right down to 25%, which means eventually going down to bear market territory, which of course means lots of assets might lose quite some grounds. And in that perspective, tech sector is the #1 in a danger zone. We've had Netflix who totally fucked up with the Q2 guidance, and there is expectable contractions as well on other sets of big market caps. That weights a shitload into the indices. And that's the reason of my concern, because of course the timing feels like not appropriate right now to sell, most importantly for a reverse, because we're generally looking for breakouts, which means we want these types of crosses on top of the prices that will limit the risks. We want to deal with volatility boundaries, we're definitely out there, but the thing is that we lack of volatility, so this makes these reverse patterns freakingly complicated to navigate. We've assessed the fact that we've had a skyrocketing bullish momentum due to some sentiment trading. That basically means the smart money did nothing, the dumb money just got against the prices, and now that prices are reversing, of course, just as expected, the dumb money does exactly the opposite. They're trying to fight against the market moving down when professional sentiment might be on the verge to deteriorate. But the problem is we still have nothing to confirm. We still are locked into this big triangle, which means things could rapidly roll out of control if other big techs were surprisingly pushing prices to the downside further than expected. That would definitely, I think, put prices under pressure and definitely deteriorate the smart money sentiment indexes. But still, as of right now, we've got nothing but suspicions. So that's the reason why I really want you guys to look at signals if you are reverse trading right now. Most importantly, reverse trading is for experienced fucking traders only. If you are learning trading or a trend follower or whatever and trying to go down these trades, Jesus fuck, that's the stupidest thing for you to do. So smart money managers and experienced money managers will in these areas look for profit taking and potential reverse trades or cover anything that is counter trendy trade. Okay, so right now it's going to be complicated. Most importantly, and that's the reason why I'm making this video today, I generally on a daily basis always look at the S&P 500, but I couldn't ignore the fact that we do have both a signal and a price confirmation on the futures daily chart. Still, like I said, normally this is not the chart I look for. But there is something I don't like in here, which is the 61% cluster extension. Remember that in here we are into possibly terminated structure of a trend. I just got fucked up in here because of sectorial rotation that just basically prevented the market to align the planets to get to the overlap, which is, I think, kind of a rare chaotic structure, but still happens. Normally this wave 1 extended overlap the wave. We're in a specific case in which sectorial rotation just basically fucked up the S&P 500. But still, This is our wave structure. 1, 2. In here, we had the consolidation just not deep enough for me to be profit taken. That's just a sectorial rotation, chaos always. Remember that things never will be exactly the way you expect them to, or rarely be the case. But in here, we're on a final wave. All we need to know in here is that generally the second and third waves to the upside are contracting each other, which means the deeper we go into the structure, the less the gains are. Of course, the higher the bullish momentum suggested to be. Of course, stupid traders buy more and more and more as prices go higher, when on the opposite, smart money managers knows that the profits will be limited and that they will lock on the gains. The gains that they've made in the first stages of these trends, of course. This is where the dumb money jumped in and bought the stock market. This is where the smart money got in, okay? So, of course, we know that it's an appropriate time to lock on the gains, reduce exposition, or cover the portfolio. We also know that looking at the stupid structure we have right now and lots of risk we've been accumulating, credit, whatever, lots of zombie companies, means that a lot of shit could happen. And my personal assumption is I'm not buying any fucking thing unless we get to 3,200. So that means hell of a drop. The question is, how do we drop it? Do we do it safe and sound, consolidative structure, lots of visibility, controlled volatility, or do we fuck it all up in a Trump way? We could definitely do this. I wouldn't be surprised. That's the reason why we need to be prepared for every type of consolidative structure, meaning that if you are an experienced trader enough to go for reverse trade, I think looking for reverse patterns in the nearby area is something that needs to be done. We have early signals in the 4-hour chart time frame because we've got into extending the bullish wave to its maximum. We've gone out of this area, and the question now is, are we going to get sufficient volatility to extend the losses, or are we going to go breaking and therefore creating the cross pattern on these 4-hour charts and extend them to the daily later on? I still believe that this is the most likely option, that this wave might have a little bit of an extension on a final exhaustion pattern. So selling hard right now is stupid. It's not possible because, most importantly, if you look at the context, you see that we're in a very late stage uptrend, and that context are getting unfolding to each other. And that means we have a bit of a problem. That means things could turn out to be stupid and things could turn out to be irrational. We know that, and that's the reason why selling must be very cautiously handled. Most importantly, we need to assess the fact that there could still be a final upside move. Reason why, when there's hesitation, you need to look for an asset that makes third range boundaries. We've talked about USD WTI, and the big boy is doing some third range boundary patterns out there. The question is, can we go one step higher in here just like the S&P 500 could do? There is a bit of room for this because the context still stands a bit higher than the current prices. So in that perspective, well, I'm still contrasted. There could be a third range boundary validated. I hear we had the taking profit patterns to suggest this could very well be the case. The thing is that it's just barely getting to validation as we reach out this trend channel. So I really would like to see either going one step higher, like we said, final exhaustion move on the S&P 500, and there would be the much more attractive prices and risk limitation to short sell. Other opportunity is we go straight line and we reverse this trend channel. So look for WTI. I'm talking to the experienced guys only, okay? The forex is still confirming that the reversal could be taking place without any further ado. So it's more an appropriate time, or do we get a final exhaustion move, or are the earnings release fucking it all up? That's pretty much all about it. Okay, look at VIX. Option number one is we start breaking a resistance immediately. Option number two, we go create a divergence pattern with a higher low point when the S&P 500 makes a higher high point. And in that perspective, we'll have, possibly with a reverse pattern, the 4-hour chart signals to get in. Okay, and we want to have the VIX not to make new lows. If VIX somehow manage into getting new low territories, then we cancel the scenario. All right. Then it comes for cryptocurrencies. Nothing too fancy out there. I'll just pure and simply explain what I'm doing right now. I'm just caring about this or this area. Anything that happens in between is totally boring. We got a mature range on the shorter time frame as this triangle's there. The question is, though, I'm caring only if we reverse and break through the third range boundary, meaning we'll extend the losses possibly down to this trend channel and minimum 47K, where we'll find some volumes and the first bulls might start to look for reverse trades again. These are second range boundaries, so experienced traders only. Second option is we rebalance for a tiny limited offer. Third range boundary option, in which we'll generally, I think, look for this trend channel and 61% retracement to look for potential third range boundary signals that will tell us either we go for a neutral range or a bearish range that will extend beyond the previous low points. Okay, remember that for trend followers, we're still in a weekly trend, okay, which means 2 time frames below. Every moving average plus a context cluster means a buy trend follow opportunity. So if we go out there, we're going to get a buy signal. The thing is that the contexts are still there, which means we need to wait for next week. If next week prices are dropping out there and we get both a context box and a moving average in the nearby area, we can buy the crap out of this thing in a weekly trend follow. So lots of supports out of the 47K area. But this requires to either wait for next week or to get a second range boundary aggressive signal. So for experienced traders only, if we get to drop this week, because that requires knowledge about second range boundaries, reversal probabilities, and if not, if you're just a yellow trend follow stuff, wait for next week, hopefully having a drawdown this week, closing at the lows, and next week you will get both your context and the moving average, which you can buy, safely putting your stop loss below the higher time frames context and the previous support, which will likely give you a stop loss invalidation out of 32K. That's a fairly interesting price to get in because you'll get quite a significant level of margin, because that means you can put a 2% risk into this trade with a stop loss at 32K. That means you can get back into the daily, weekly trends with an appropriate risk taking. So lots of you guys were wondering where to get to jump in. The Bitcoin, that's definitely one way to do it safely. Anyway, that being said, we'll see and we'll talk about that in the weekly updates, of course. See you guys later, and be patient in the meantime, please.